2011 with an increased monthly buy signal. Now, there will be pullbacks that come because basically what led this market higher, if you really understand how the S&P 500 down here, the earnings, up here the earnings were valued at about $120 on the S&P. Down here I said that the S&P earnings before we ever got there were worth about $55 to $60 in the whole S&P 500 group. That was where the buy was. Okay, now we have re-levered back up over the last couple of 8 quarters, as 2 years in the S&P 500 companies, and the leaders have stockpiled and executed well around the world, and basically the earnings trough in itself is going to kind of peak out based on money supplies around the world. And you also have to account for what? There's a nasty word that's going on. Inflation. Not here in the U.S. That comes next year. But inflation in emerging markets are here and have been, and we talked about that in 2010 of what that would look like, and we're hitting right on all cylinders there. What I want people to know is that as we come up here to this particular bar, right here, this is half of that SMF market maker bar right there, and we're hitting on all cylinders. What's going to end up happening, there's going to be some distribution into the move. Everybody thinks traditionally that there has to be what we call, like there always is, a spring rally, and there's always truth to it, because generally you sell off. In the last 3 years we've sold off in the S&P in January, and then kind of went flat to a little bit more down in the February mode, and we put the bottoms in, and then the spring rally comes, and everybody comes out of hibernation. However, guess what? They've been out of hibernation in this last up move right here. We've gone straight up when we couldn't break these bottoms down here on the S&P. Okay, we had a double month pullback, but we could never break that bottom, and they didn't. And the bears stayed on stupid. And unfortunately for the bears, with all their pessimistic views, which they're entitled to, but the tape says quite the opposite. And out of the last 6-month period, because this monthly bar is not over until the end of February, and today's date is 2/19 of 2011, and that's another important thing, Tommy, two-tone, is that the bigger community will start to take profits right up here at 1350. We're right coming into there. They'll be trying to see if they can close above that bar right there. And the thing about it is that the earnings cycle, when you take a look at Europe, when you take a look at Brazil, when you take a look at Argentina, when you take a look at Australia, when you take a look at China and the Pacific Asian Rim, is they're overheating. And things are starting to change. When you start taking a look over there in the country of Mexico, they did well coming off the bottoms. Their markets had moved, and a lot of people in the bigger community are asking me questions. Well, why do we keep going higher? Well, listen, the U.S., as I said in 2010 analysis, for the hedge fund managers that are watching the tape, not EMMTs, those people right here, there, is that, as I said clearly, safe haven is where do international fund managers want to get involved with U.S. And even though that the U.S. picture, in my view, there's a lot of headwinds that are ahead of us in 2011. There's going to be some severe problems in 2011. However, they're finding that the U.S. is probably the place to be, as I said they would. That is why we've had a 3-month breakout. Now, when you take a look at U.S. equity inflows in the beginning of the year of January 2011, and you take a look at the international money inflows, you can see that that inflow of cash that is moving off the sideline because the risk trade is on. As the risk trade continues, that's how we keep climbing. The thing that the bull will have to worry about in the short term is a number of things that we will address in our radio show. The thing that we're going to talk about specifically is the indexes, the leadership in the S&P 500 will have, they'll be selling those names, and we're going to take a look at it mathematically now, not opinionated. But the bulls have got everything going in their way. However, that bear has got some key factors going in its direction too. And one of them just so happens to be on this public technical indicator called the percent DS, about being overbought and oversold. We're at 90.51% on a monthly level. And we're going to hit like we always do. And a lot of these bull trends in the short term can end up being pretty nasty for people who are caught at the top. And we're getting closer and closer each day to that top. That's where the bear has some things going for itself. And the bull is going to have to see continued inflows in money flows in the month of March. Because what happens is that the bear and the bull count, are totally lopsided. Meaning that mathematically you got too many bulls, and mathematically you've got very little bears. And what happens is, in the bigger community, they have a tool called their contrarian thinking, always trying to get on the other side of the public. They're just as much public as you. They're not market makers on the floor. They don't know the true story either. The story remains one thing, is that when we get too upside here, we have to have what we call pullbacks, and they're healthy for the market. What new MMTs in the market maker school, the apprenticeship year here, is going to learn is how to trade those pullbacks when they come. And there will be 4 phases to the pullback on the S&P. The next video that